Mr. George, welcome to ET Now. As me and Kavita were discussing, if you compare the 6 months trajectory, we are still up 6%. How do you see market moving in near term and long term as far as Nifty and Sensex are concerned? And more importantly, which are the sectors one should bet on if at all they have to do?
Yeah, thanks, Ankur, for having me on the show. So if you look at the recent market performance, you have to, it is in the back of a couple of things. One, so if you look at the earnings profile of companies, it has been a bit muted in the recent times. So for the March quarter, the aggregate revenue growth was in single digits. It was around 6-7% kind of level for the BSE 500, and margins were kind of steady. With that, and even valuations were not conducive enough for a favorably high return in this kind of a muted earnings environment. But going forward, our sense is there are few things which are turning in the favor for the economy. One, the higher than expected rate cuts would have an impact eventually in terms of boosting consumption, and even in terms of justifying some of the capex projects which could come up a few quarters down the line. Plus, the monsoon has been reasonably good, so you would see some uptick even in terms of the rural economy, and even the irrigation and all the tariff sowing has shown a reasonably healthy trends. So with all these and a very reasonably low base of fiscal year 25, our sense is things should improve from here on. But having said that, investors should be selective in terms of picking names, because valuations on the broader markets are not very cheap. And compared to the returns what investors have backed in the last 3-5 years, probably the next couple of years could be slightly lower, but could be a lot lower compared to what we have seen in the last 3-5 years. But still, it's a reasonably healthy number.
All right, Mr. Thomas, hi, this is Kavita. Let's elaborate slightly more on the broader market side, mid cap and small cap. I don't think so it's the time where we can take both the market caps name in one breath, okay? So let's go market cap specific. And concern on valuations. There was a reversal that we saw in between where investors also got a lot of profit made out of these kind of exposure in their portfolio. I'm talking from a portfolio perspective for a longer term horizon, absolutely. But then, then the valuations were slightly cooled down, and now are we still looking at, the question to you is, are we still looking at some kind of a time correction in specific pockets, and how are you placed in terms of sector specific valuation exposure as far as mid cap and small caps are concerned?
Right. So for mid and small cap, investors need to be slightly more selective, because there are froth in many pockets. So if you look at our quantum small cap fund, we are at around 13% cash, which is on a higher side compared to a normalized environment, which is reflective of how the valuation is panning out in that domain. So some of our recent additions in the small cap fund has been in auto ancillary, and one company which is catering to the FMCG sector. But investors has to view that on a bottom up basis, because there are no you cannot paint everything with one brush. You have to be very cognizant of valuations and how the bottom up stories are kind of panning out. From a broad cohort perspective, small and mid cap continues to be fairly expensive compared to its own historic average. Not so much on a PE basis, but if you look at price to book, which also gives you a sense on where the profits are relative to historic range, you would see that it's a lot more frothier to that extent. Therefore, investors need to be fairly selective in those names. The companies where we have added in the auto ancillary space, they have been seeing some bit of addition in terms of their clients, number of clients they have in terms of the auto OEMs, the foreign as well as Indian, and they are seeing some bit of increase in their components per vehicle. So investors needs to be extremely selective in that pocket.
All right, George, just want your attention on one of the PSU bank earnings which has come in that is Indian Overseas Bank. The net profit has risen around 75% at 1,111 crore, and on the back of it, you can see that stock is up around 2%. But more importantly, George, I want to understand with you the overall PSU bank sector. Last couple of weeks, there has been a lot of action. You have seen the rate cuts which is already out of 50 basis point, and there is a clarity as far as the rate trajectory is concerned. How do you see this space panning out in near future?
From a PSU bank's perspective, we have been extremely selective. We just have one holding which has a fairly large franchisee and it enjoys one of the lowest cost of funds. But otherwise, if you go down the ladder, our sense is the management quality and underwriting quality is not probably at par with some of the best names in the sector. So from a banking perspective, we are fairly constructive. Our sense is even though there could be some bit of margin pressures in the near term because of the rate cut, but market has kind of factored it. And some of the asset quality issues which we saw in some of the pockets like personal loans, credit cards, and even MFIs, that the worst seems to be behind us. So our sense is the asset quality environment could remain reasonable in the medium term. Plus valuations have already priced in the kind of margin pressures which some of these banks could see in the near term. So from that perspective, considering where the valuations are compared to their own long-term history, so that some of those banking names offer a reasonably a good upside, and we are more optimistic on the private sector space.
All right, so that's your take on the BFSI space. But then I really want to draw your attention towards the chemical sector, chemical and fertilizer. Now, looking at how Niti Aayog has released a report outlining a roadmap, to boost India's chemical sector. Is it somewhere in your portfolio or on your stakes? Are your stakes high on this particular sector? What's your outlook? Looking at the new outlining and structural change that we are also looking at.
See, we have no exposure to chemical sector in the portfolio, primarily for a single reason. For in many of those companies, they are dependent on how the large supplier from China kind of behaves and how their dynamics kind of pan out. And it's very difficult to understand the moat in many of those specialty chemical companies and companies where it's more to do with how a particular geography or players within that geography kind of behaves. And given the scale at which many of those companies operate in the country, we do not, in many of the cases, we do not see a structural benefit in terms of advantage in terms of a competitive cost of production and stuff like that. There could be selective cases, but from a broad sector perspective, we have not been able to marry valuations along with these fundamental metrics.
All right, Mr. George Thomas, thank you so much for joining at this hour and sharing your views on market and sectors.